So we now do another example, pretty different, not the same thing at all. Alimentation COUCHE-TARD. So the same 9 questions, we go through them one by one. First question, do they have a moat? Do they have a consumer monopoly? The banks was pretty clear. Alimentation COUCHE-TARD, if we think about what they built, it is dépanneur, it is proximity, it is things like gas, cigarettes, beer, gum, stuff near the house at footwork from where you live. So you stop there, going to work, coming back to work, and it's big network of many stores. Will Amazon be able to compete on that? Maybe yes, maybe no, we don't know. But though they have a moat, we will go and check into the financial results to see their margins and stuff. So we go there. Again, morningstar.ca, good website. Click on the stock. Alimentation. We go in the key stats, very efficient. So in the key stat, we see the revenues go from 15 billion to 37, and the trailing 12 month give it 43 billion. The gross margin, that is where the gross and the net operating margin. So the gross margin here we have 14. So that is what they make on everything they sell. We go from 14 to 15, 14, a dip in 2012, 12.9, 13, 13.1, and then back again to 15, 17, 17, and we are around 16, all of that. So from 15 billion to 43 billion, if you look, almost 3 times the revenue, and a gross margin of 14 to 16. So they are very savvy on the way they buy. They price their thing right, and they don't sacrifice margins. So I would say they are very healthy as far as that is concerned. And now if you look at the operating margins, we forget about the 22.2, we went from 2.6 to 4.5. So on that matter, of course they don't have a monopoly, but they are operating in a way in which they make consistent good margin, good profit. So we can say they have not a monopoly, but a very strong moat on that matter. We continue because we are at the right place to have the perfect view. The earnings per share, are they strong? Are they upward? So they went from 31 cents, 43, 65, 83, $1, 209, 212, and the trailing 12 month is 240. So the answer is yes, they are upward, and yes, they are strong. So there is it's a no-brainer, no problem there. The other question is about the are they conservatively financed? So if we go and see in the we can, because I want to make you more at ease with that website. Maybe you are right now, but just it's part of my of the teaching. So we go in the balance sheet. We can go to see the ratio, but just go in the balance sheet. Like I told you before, I just hide the asset because we don't need all those lines. I can hide the current liability, so I have a more simple thing to look at. And if I look at a long-term liability here, just by the eye, okay, I see $3 billion in liability long-term, and I see the stockholder equity at 6. Very easy to divide. They owe 3 long-term, and they have 6 in the balance sheet. So it's a ratio of 0.5. It's 50 cents on the dollar of shareholder they owe. So with all their acquisition, all their things, they are conservative. They are not over their head in debt. And if you look at the progression, I like the numbers, but you have seen me before. I like the progression of the number. You see the long-term debt, 2.9, 2.5, 3, 2.8, 3. So there is not a hypertrophy of the ego like Jarislavsky would like to say. So that is answered too. We continue. So the 1, 2, 3 is yeah. Oops, I will have to change that. 1 minute. Here you go. So I have entered my answer very easily. Now the question number 4 is, do they have a high rate of return on shareholders' equity? Again, we go and see. So we are Morningstar. We are on the tab Key Stats, and we just have to go down. And here you can find the return on equity, just here. All right, sorry. So we go from 15, 19, 20, 20, 22, 21, 22, 23, 26, 21, and 22. So the answer is yes, they have a very high rate of return on shareholders' equity. That is not a problem, and we have seen some, but it's normal to see variation, but there is always a reversal to the mean, and we can see that the mean is around 20, 21, 22. I give them a 9 out of 10 because very high return. So again, the question, do they get to retain their earnings? We'll see that a little bit in the balance sheet without going too deep. Do they spend, how much do they spend on maintaining current operation, and is the company free to reinvest their retained earning? We go there. So one of the ratio we can look at is the capital spending ratio in US dollar in million dollars here. Cap spending, we don't go too much, but just a little bit. So we see the cap spending is 280. That it doesn't seem very big compared to the numbers at the bank, but you have to compare that to their net income. So here you can see in 2008 they spent a capital of $280 million, but that net income was 189. So they spent more in capital than they earned as a net. If you remember the Royal Bank, or go back to the video, the Royal Bank, they have like 1 billion over 6, 7, or 8 billion. So it's 1 out of 6 here. It is 280 on 180. So they spend more. If we look in 2017, we have almost $1,994,000,000 of capital spending. Capital spending means in the equipment, in things that are not expenditures, something that you will buy for 5, 10, 20, 30 years that are necessary. Computers, for example, computers, you can buy a $1 million worth of computer or cash register, but you don't expense them in the same year. You will amortize them over time. So all those things are called capital spending. And some business need more capital spending than others. Here you have 994, but the net income was 1.2 billion. So they are spending more than the bank. They are not the same. It's not a financial business. They are spending more. They are buying competitors. They are buying, and so they're spending more capital. So they may be a little bit more stressed on cash. And the obvious is that if you look at the free cash flow per share, right now we have $2.27 of free cash flow, meaning that the cash flow that is free to the company, and it's trading at $63. So it's thinner. Remember, by Royal Bank it was at $27 over 100. Here we have $2 over 63. So that's why in the last year, 2 years, the stock has slowed down a little bit because the company is a little bit maybe overextended. So it'll take the time to digest everything it has done. That's absolutely normal. Nothing to be afraid of, but just a completely different picture from the bank. Is the company free to adjust prices to inflation? Of course they are, because they are selling gas, they are selling cigarettes, they are selling Coke, they are selling consumer products that will flow with the inflation. And people, it's small amounts, and if a pack of gum go up 3-5 cents because of this or because of that, of course they are able to adjust, and they will always maintain, if they are managed well, their net margin. So that's not a problem. They are not doing gold digging or silver digging or in the commodity. They are in the retail, and they can adjust to inflation. Not a problem. And the last question, are the retained earnings, are they increasing the market value of the company? So I have made a slide for this one. So the first column is, as you know already, earning per share of the last 10 years. They went from 31 cents to $2. We add them. It's $11 worth of earning per share. Company have paid some dividends, 4 cents a share in 2007. It went up to 5.9, and now it's 25 cents a share. Not much, but it is still there. So $1 and $11 they have paid. The retained earning per share is $10, and the stock price was $6 in 2007. So is the stock worth more than that? You bet. The stock now is 63. It was at 65 at December 31st. It's now 63. So of course the stock has reacted very, very favorably, but that's why we have seen a correction and maybe a stall, because we see in 2015 the stock was at 60, and 2016 60, 2017 65, and now 63. They went ahead of themselves. Like we saw before, Mr. Market went very enthusiastic, saw the number, liked what he saw, and he anticipated the growth of COUCHE-TARD. So the financial, the balance sheet, the financial are very sound, but the stock market got ahead of themselves a little bit, if to not to say about much more, because they have $10 of retained earning, but the stock has gone up $59. So the stock has gone up a great deal if you compare to the financials. So it's extended, and that's why for the last 2-3 years it has remained more at the same place. And finally, we can see the price is 63.42. Sorry, not French, it's English. 63.42. The PE ratio, I forget to look at the PE ratio. I will show you where it is, of course. So the PE ratio is on the first page. You go completely down, and you should find it right here. So the PE is at 21.7. The industry average, not the stock market, but the industry average for that type of business is 18. So again, that stock is priced a little bit higher, more quality and stuff. So 21.7 is the price earning. So is the company a potential buy? In the essence of the company, the essence is very interesting, of course. But at 21.7, and the way it has gone up in the last years, let's just say that the stock market has priced very much and pretty aggressively that stock. So it is, yes, I would say it's a nice company. It's a very well managed. I think for the long term it can be of a good value, but right now it is a bit high. We have seen that in the last 3-4 years it has stayed the same. Nothing is to say that it will not continue, but it's more fragile situation than with the Royal Bank. It's not the same structure, the same thing. If there will be something terrible in the market and we will have like a correction or something, a sale, that would be the perfect stock to grab onto a sale, because even if the stock market Trump does something crazy, Korea du Nord or North Korean or what have you happen, all those dépanneurs won't change place. But if the stock happens to be at a sale, then you can whistle like Warren Buffett and say, hey, I like that. And to finish this little video about Alimentation COUCHE-TARD, I have a trivia question for you. Amongst Alimentation COUCHE-TARD, Amazon, Apple, and Google, I would say on those four, how would you rank Alimentation COUCHE-TARD? I do that in my groups. It's very fun. I put a book for the drawing and a contest and stuff. We have fun. And it's very surprising. So Alimentation COUCHE-TARD, you have four. You have Google, you have Apple, you have Amazon, and you have Alimentation COUCHE-TARD in the last 5 years. As of this recording, I will show you. I cannot have the same reaction as in my class because it's not, but still. So COUCHE-TARD, what we do, we go in Morningstar. Very simple. I click on the 5 years, the last 5 years. And here you see I have 296%. That's why in the last 5 years, the stock has appreciated 296%. That's a lot. That's for COUCHE-TARD. I will go and see Apple stock. I will hit the 5 years button. Apple stock in the last 5 years, only 157%. So COUCHE-TARD is better than Apple in the last 5 years. We continue. I told you about Google. So we go to Google. You do the same. Google 212. So Google is even below Alimentation COUCHE-TARD. That's always blowing people's minds. So 212 for Google. And the last but not the least, of course, we have talked about that stock a lot in the course. Amazon. Of course, Amazon will win. That was almost a no-brainer, but still. 5 years, look at that. In the last 5 years, Amazon have gone up 446%. That's a bit much. So we'll see what happens after that. For me, it's like, okay, I understand the craze, but anyway, it's not a Buffett stock. I haven't analyzed it. It's not worth it. There isn't, all the numbers are completely wacky on a rational way of thinking, but it was just a piece of trivia I wanted to leave you with.